Hello, everyone. Welcome to the second episode of TechCrunch Live, TechCrunch's new live via Zoom and YouTube speaker series with investors and founders from the private sector. Our goal, as you can imagine, is pretty simple. We want to understand this new changed world that we live in. My name is Alex. I'm one of TechCrunch's venture capital and startup focused reporters, and I'm happy to introduce my co-host, Natasha Mascarenas, who operates in the same capacity. Tosh, how are you doing?
I'm doing well. Long time no see.
It's been about 45 minutes. But critically, we have some stuff about Otter, and you're going to tell us who we're with today. So go for it.
Yeah, so just a heads up, thank you everyone for joining us. This chat will be transcribed live through Otter AI, so make sure to check that out after. Excited to share that today we're joined by Precursor Ventures, Charles Hudson. Hey Charles, how are you?
I'm good. Thanks so much for having me.
It's good
Thank
to have you
you for
here.
coming. I'm all set up in my living room, and it looks like we're all in our new normals. But today should be fun for those of you who don't know. Charles Hudson is the founder and managing partner of Precursor Ventures, a pre-seed and seed stage investment firm. They invest generally across B2B and B2C software and hardware startups. Founded in 2015, does about 15 to 20 investments per year. We're definitely going to check on if that's changed. And Hudson has also, kind of before working at Precursor, he was an investor at Softtech, co-founder of Bionic Panda Games, and happy to include he spent several years at InQtel at a venture group of the CIA. How did I do?
Perfect.
Amazing.
Even more so, kind of adding to that pedigree that Tosh just outlined. Charles, you've been on Equity, our podcast, twice, and you've been to Disrupt at least one time. So you are like one of the most tenured people to bring onto the speaker series. So I'm very glad that you're here. Before we jump into what we're going to talk about today, we have to do the polite thing and ask, how are you and your loved ones? And quickly, how is life treating you in this new reality?
I think I'm personally doing okay. My family's safe. My family and my in-laws are both in Michigan. So I'm frankly more worried about them, given
Yeah.
particularly that Detroit has been particularly hard hit. We've been sheltering in place here in the city, and I have a toddler son who I think is young enough to not really have much perspective of what's going on. So I feel very fortunate that we're healthy. Unfortunately, some of our portfolio company founders have fallen ill with COVID, and so have some of their family members. And so it feels very close.
Yeah. Well, with that, we're going to talk about what we're doing today. Kind of three parts to this conversation, a little bit about Precursor to start. Then we're going to talk about the market more generally. And then we're going to reserve as much time as we can for audience Q&A. So if you are with us live on the Zoom, not the YouTube, feel free to drop questions into the chat or the Q&A function. Anna from TechCrunch is going to collect those for us. And then we're going to get to as many as we can towards the end. Of course, as always, be cool, be nice, and don't be too self-promoting. And we'll get to as many of those in a couple of minutes. But let's start with Precursor and some kind of basics, if that's okay, Charles.
Yeah.
We were curious, is your firm still writing checks into new companies, not follow-on checks, but brand new investments into firms, kind of since the second half of March when things really changed domestically?
The short answer is yes. We've been wiring for new investments. We've been making them. I have one term sheet out right now where we're trying to build a syndicate. I have two founders who recently texted me because we've committed and we're trying to figure out a close date where we can wire and get it done. I would say that we're going at a slightly slower pace, though, mostly because it's been trying to balance three things. We're wrapping up our new fund. We're obviously trying to support our existing portfolio companies and trying to do a good job of processing the new things that are coming in.
And I understand you guys invest around 100K to 250K in most deals and co-invest a lot. I was wondering what co-investing is looking like in a world of Zoom. Like, take me through that.
It's really interesting, Natasha. When I started the fund, we have companies in Dubai, Mexico, Nigeria, Canada. So we've always operated with this idea that we can back people that we met over Zoom or on the phone. This is probably sounds embarrassing, but it's true. I have San Francisco-based founders that I didn't meet until after we invested, which sounds kind of ridiculous unless you live in San Francisco and know how hard it can be to get around the city under normal circumstances. And it's interesting when we first started the fund, a lot of LPs said, well, how can you possibly invest in these companies where you don't get to meet the founders in person? How do you support these teams that are far away? And it just was never an issue for us. I feel like most of the things we want to get about the person and the idea we can get out of video. The only difference is I try to use the sort of 3-to-1 rule, which is for every 3 video conferences or video interactions, you want to try to have something face to face. So I think it's great for sustaining. So for us, it hasn't really been a huge change in the way that we work. I gather it's very different for my friends in Series A land when I talk to them, though.
I want to go back to the pace point. You said things are slowing down a little bit. Is that slowdown increasing as we get deeper into April? Because my impression is that things began to change. The lockdown happened, and then everyone kind of refactored how they approach things. And then the economy began to get a little bit worse and fears seemed to rise. So I'm curious if you're seeing your own pace begin to kind of keep decelerating as we get deeper into Q2.
I think our pace is decelerated more because I'm spending time on wrapping up the tail end of our fund more so than like a diminished appetite to make investments. It's definitely not that. It's definitely not fewer good opportunities. That hasn't changed. I would say the only thing that I've observed from my peers is on any given day as a venture capitalist in this environment, sometimes your risk appetite and your emotional fortitude to make a new investment depends on the last 5 conversations you've had with your existing portfolio companies that are trying to navigate the crisis. And I think on days where it feels like the portfolio has it under control, you honestly feel better about writing checks. And on the days where it feels like things are a little bumpy, it's natural to feel the pull back. But in pre-seed, most of our companies are 6 to 12 months away from sort of launching a product and maybe 9 to 15 months away from needing to fundraise again. So as long as you think the world with that lens will be open to new ideas, I think it makes sense to keep investing.
On your point of risk appetite, I was wondering if any sectors have kind of come or left your radar as quarantine, coronavirus, et cetera, et cetera.
I mean, I looked at a restaurant tech company. I looked at a travel company. I haven't funded either one of them yet. I think the areas that I have the biggest questions about, honestly, it's fitness. It's probably the one area where I look at just the nature of a lot of particularly facilities-based fitness. If you look at some of these models, they were predicated on having a fairly dense room of people together, having kind of a share, whether that's SoulCycle or Barry's or whatever it might be. I think a lot about, is that going to come back in the same way when this is all over? Are people going to feel comfortable sweating 6 inches, 2 feet away from a person who they don't know? So I've been thinking about that a lot. I've been thinking a lot about businesses that are levered towards business travel and face-to-face selling. Like, how does that come back? And I think the problem is like jumping on telehealth or jumping on distance learning. Like, everybody sees those as obvious. And so if you decide to pile into those, you should be prepared to pay the price for something that feels obvious.
I want to go back a little bit, Charles, to the conclusion of your second fund. If I recall, it's a $30 million vehicle. Is that right?
That's right.
And then you also put together a $10 million opportunity fund. And if I recall our talk about that from Disrupt last September or August, you said that was to put a little bit more money into certain companies that were excelling. Is that right?
That's right.
And is that fund also wrapping up?
It is. I can't say more than that, but it is wrapping up, and we've made quite a few investments out of that fund already, predominantly into Series A rounds of portfolio companies that have been making really great progress.
All right. And I know the answer to this next question is going to be something along the lines of, my lawyers will get mad at me if I answer this with detail.
Do it.
I'm going to try to ask this in a way that you can answer. So here's a shot. Your firm filed a Form D earlier this year, indicating you're looking to raise a $40 million fund for kind of Fund 3. I know you can't talk about the fund in particulars or kind of fundraising rules and so forth, but I'm curious if you have any general notes about the LP market, maybe over the last month or two, that you might be hearing from other people, say, that could give us an idea about LP risk appetite, because we're curious about how funds of your size will keep raising as 2020 keeps going.
We talk to LPs all the time, whether we're in an active fundraise or not. And I got to tell you, I've heard some things that have really both shocked and scared me. So I'll give you some anecdotes that I hope will protect the identities of the people who disclose them. So I'd say one of the more fascinating conversations I've had, and it's, I think, been very topical with PPP. I talked to a lot of university endowments, many of whom are looking at a world in which student housing and room and board and meal plans are like a real driver of the income profile of a school. And a lot of these schools are looking at the possibility that students won't be on campus in the fall. And so the endowments for the universities are looking at a world in which the financial support they might have to provide to the university that they're connected to might be orders of magnitude larger than the ask in the past. And the only place you can really get that money is from the liquid side of your portfolio, which is experiencing a high degree of volatility. So I think a lot of those folks are sort of worried about um, the ask. The other thing I will say is I think there's been a lot of chatter on VC Twitter about how so many VCs can't make an investment without meeting a person in person. Many limited partners, particularly the institutional ones, their processes mandate site visits or face-to-face in-person interaction with GPs before they make a commitment. And that's not happening right now, or it shouldn't be happening right now, given all of the guidelines. And so I've had more than one or two LPs tell me in February or March that they are done for the year. They can't envision a world in which they're going to make new commitments to new managers in 2020. So I think like it makes me very nervous because I'm a pre-seed investor. And as you all know, pre-seed is the sector of venture that tends to attract the most brand new firms. And a lot of those firms can be fragile. They can have fragile limited partner bases. It can be family offices or high net worth individuals who are severely impacted by the public market declines. And so I worry a lot for my peers in pre-seed land in particular, or in seed land who are on fund one or fund two and maybe had planned to raise in 2020.
Yeah, I mean, I feel like that's a relatively new from what I've been hearing on Twitter. Like, I feel like it's focused more, maybe just by my followers, focused more on founders struggling to secure checks. But I didn't think about that LP side, and I wonder if this is a moment for some of those old processes to be renovated. I mean, is there one where we're not going to see a new, $1 billion fund this year? Probably not, but I do think it might get some gears turning that we should try renovating those processes.
I have a programming note from the powers that be, which is that if you're dropping questions into the chat, you should drop them into the Q&A function on Zoom. That's where we're going to be pulling them from. So if you put them in the chat, federate them over, and then we'll get to them in a little bit. We're collecting them now, and so we don't want to miss your brilliant point. Charles, before we move on to a bit more about the market, I have a kind of a nerdy question about LPs before we go, because it's just been stuck in my head. I heard from a couple of people that raise larger vehicles than what Precursor does because they're focused a bit later stage, that LPs have kind of like an allocation limit that they put towards venture funds, and that some VC funds have done well, boosting the value of those in their portfolio as the markets have come down, making them appear more exposed to venture. I'm just curious if you've heard anything about that, because that could also change LP investing patterns for funds of all sizes up and down the series chart for startups.
Yeah, I think one of the most humbling things that happens when you raise a venture fund is you realize how small venture capital is in the grand scheme of things for the portfolio constructions of the people who fund venture funds. So if you think about, a big institution, they might have half of their money in public equities. They might have a big chunk in bonds. They might have a big chunk in real estate. Then they'll have a bucket that's private equity. And that bucket that's private equity will be split between buyout funds, PE funds, and venture funds. And as you all know, the world's largest buyout and PE funds dwarf even the largest venture fund. So venture ends up being this really small chunk. But to your point, Alex, what ends up happening is they have portfolio construction models that say we want X% of our dollars in venture. And when the public markets are on fire and ripping up and to the right, then venture, even if it stays flat, becomes a smaller percentage. And when the opposite happens, even when venture stays flat, it becomes a much larger percentage. And so I definitely have heard LPs who've said, hey, especially back in February when the markets were very, very wobbly in February and March, saying like, it's hard for me to even size what our venture portfolio is going to land as when our public markets are swinging 5, 10, 15% a week.
Totally. Let's move into the market itself. One thing that I like about Precursor, and one reason why I wanted to talk to you, is you do invest around the world, and so you do have a bit more of a global perspective as opposed to other VCs that kind of invest in their neighborhood. And so I'm curious if, as you talk to founders around the world, certain areas are seeing their seed market stay a bit more stable and healthy than others. And I'm curious if certain geos, certain locations in the US or around the world appear to be suffering a bit more from a slowdown or an increase in fear.
I definitely feel like I definitely feel like our US founders seem to have the highest sensitivity to this. We have a couple of investments in Mexico and in Latin America. It just feels like it hasn't been the same level of urgency, but that's as of 2 weeks ago. Like I don't know what the current state of affairs was. I think in the San Francisco companies we have felt it the most because I think so many of the local tech companies went early to work from home and took precautions early, and San Francisco shut down early. So I think the Bay Area companies, I think, were sensitized to it really quickly. I'd say when New York went through the same process, our New York founders really sort of started to get the message there. I don't get the sense that it's evenly distributed, though. We have some companies that do a lot of business in Asia where they're starting to see their customers come back already.
Mm-hmm.
And it's hard for me as someone here in San Francisco to advise them because I'm like, wait a minute, are you sure this isn't a false signal? And then, particularly in sectors like restaurant and hospitality that are impacted here in the United States, in some cases, they're seeing the beginnings of newfound demand.
Okay. Tosh, do you want to jump in or do you want me to keep going? Happy to.
No, yeah, I was gonna say, I wonder if in your view, is this a time to be joining into new markets, or are you kind of staying as is in the current global markets you're in pre-existingly?
So we made our first investment in the Middle East. We closed that earlier this quarter or late last quarter. People always ask me, "What's your thesis?" We're just people driven. We're very focused on the founder, his or her insights, their unique knowledge about the problem they're trying to solve. And that takes us to really interesting geographies. Sometimes it takes me to the Middle East. Sometimes it takes me to Mexico or Nigeria. So I don't have like a top down thesis, which is I want 10% of our portfolio in Latin American fintech. The thing is, when you have we have made 178, I think, investments in total in the life of Precursor. When you have a big co-founder sort of community, you end up seeing things from all over the world or all over like their networks. And so I feel like we're lucky that we get to see a wide variety of companies. But yeah.
On that note, did you feel like you were prepped in some way for the shock that was going to come to the States and to San Francisco, even though we were relatively early in reacting? Do you feel like you saw some tremors beginning?
Honestly, no. I remember talking to some of my friends at Andreessen relatively early, and I was like, wow, you guys are really intense about this. You must know something I don't know. And I would say for the last 2 years in Ventureland, we've been talking about, oh, there's a macro slowdown, the bull market's extended, but I don't know, like I graduated from college in 2000, and like I remember the downturn of 2001. No one really saw that coming. I'd say in '08, it got worse faster than anyone thought. So my working theory coming into this year is if we have a slowdown, it will not be due to any of the things that people predict. Because if it's the things that people predict, you can insure against those, or you can try to protect yourself against those. These things tend to happen from the things that people weren't looking out for and hadn't insured themselves against. And so I have to say, like, it was very surprising to me how quickly things changed. And, I think particularly we have a generation of founders in our portfolio, at least, who their professional careers have never seen a moment like this. And I give them a lot of credit for kind of quickly adjusting and, digesting the seriousness of all this.
Yeah, I was always curious what percent of current day venture capitalists weren't in the business in 2008 and therefore essentially had only ever invested when the market was just doing this, just going straight up. It must build a certain risk tolerance, risk preference, kind of like investing thesis to have only seen the stock market go up, 5, 10, 12, 20% a year. And you think you're brilliant because everything just goes up.
Mm-hmm. And I just think like, I just haven't seen people haven't seen down rounds in a long time, cram downs, all of these things that happen. And it's interesting. And I think also just the thing that makes me excited though, is I think there are some categories where it felt like the companies that could win had raised so much money that no one would ever catch them. And now it feels like a lot of those categories are up for grabs again, because the things that are an asset in an up market, lots of employees, lots of balance sheet cash, lots of customers, a big valuation, some of those things, maybe minus cash, become liabilities when things get tougher. And I think you're going to see unexpected winners in some of these categories where you might have thought we already knew how they were going to play out.
Can you tell us a little bit more about the categories you think are kind of newly up for grabs, at least in your thoughts?
I actually think there's a lot of if I look at what the companies I've seen that have taken the biggest hits or that I've seen make the biggest reductions to their operating expenses, it's been some of these B2B SaaS companies that had grown to be really, really large, but maybe hadn't quite figured out all of their unit economics and maybe had a good idea. So maybe it was a vertical market provider that was serving a vertical. I mean, I feel bad picking on specific companies, so I won't. But
Fair.
I think there's a lot of late stage B2B companies that are multicorns where I think most people had assumed, even recently, that their success was preordained. And I don't know, as an investor who's been through this before, my experience has been when you're a high growth company, that becomes part of your company's culture. It becomes part of your DNA. And I'm not sure you can cut 50% of the OpEx from some of these companies and still have a company on the other side that's interesting, that has that same energy or that's poised to win. It might be the company that never had to cut in the first place, that was 25% smaller going into this, that's able to grow, might surpass them. So I wouldn't be surprised if there's some categories, particularly in B2B software, where the people that we thought had sort of a commanding lead, when this is all over, it turns out that they had the misfortune of having to cut too much at a time where it created opportunity for other people.
Yeah, something that we've seen at TC, talking to companies that are announcing rounds in the last couple of weeks, is they always have this refrain: we've always been capital efficient, and those companies seem to be having no problems picking up more capital. And the companies that a year ago wouldn't leave us alone are suspiciously quiet, which I'm also paying attention to. I want to talk about the jump from pre-seed to seed to Series A. We spoke to Workbench from New York City. Great guys working in B2B. And they're big on the seed 2 round, kind of some capital in between seed and Series A that lets companies, find product market fit and kind of gear up for larger raids. They can kind of put more money and go to market. Advice must have changed that you're giving your founders about how to approach preparing themselves for the next stage of investment, the next stage of valuation, just maturity as a startup. So I'm curious what different advice you're giving your portfolio companies today, especially as they think about surviving in a time of uncertainty that could last for quarters.
I think it's a really hard time as an investor to give companies definitive advice. So I've tried to tell them a couple of guiding principles. One, I would say if your numbers are not up and to the right, and we have companies that are accelerating growth during COVID because the product they have is uniquely levered to this moment. Ironically, these are the same companies that struggled to sell before because the status quo was so compelling. And I'd say if you're not one of the companies that's really growing through this, try to avoid raising in 2020 if you can. You might not be able to, but I would say if there's a way you can push your fundraise out to next year, I would do it. I think one of the toughest things I've seen in venture right now is that there's this weird dynamic where I think every investor has a different view for what's the right amount of runway for a company to have. I'd say the minimum I've seen people say is 12 months, but I've seen people out here advocating for 36 months. As you can imagine, if you're a founder, you run your business very differently on a 12 to call it 24-month runway than you would with a 24 to 36. And what I've told our portfolio company founders is, remember, when this is over, whenever that is, I don't know when that will be, you're not just competing against companies that survived COVID. Like, that's actually not the competitive set. The competitive set will be companies that survived COVID, companies that actually grew during COVID, and most importantly, brand new companies that are started on the other end that do not have any of the trauma of having gone through this. And so if you're surviving just to survive, I actually think, I don't know, this might be too touchy-feely. I really care about the people that we invest in and how they spend their time in their lives. And so I've asked a lot of our founders in our portfolio, are you excited and prepared to run this company for the next 2 years? Because if you aren't, there's never been a better time to maybe fold. And I think, like, in an up market, nobody has that conversation because it feels like money's plentiful and everybody's going to get funded. So I've told people, the other thing I'll say to your point about advice is, you're probably not going to get the benefit of the doubt for unproven stuff in your business model today. Whereas maybe 6 months ago, if you had a business model that you hadn't rolled out and tested, but it felt really obvious, people might have said, yeah, that's probably going to work. We'll give you the benefit of the doubt. In this environment, I would say, like, evidence beats everything. So if you've got something that your whole business hinges on, odds are much better that you're going to get money if you've proven it than if you're asking people to say, hey, give me this money, and then with your money we will prove this really important thing.
Okay, so summarizing that, just make sure that I'm getting this. You're not telling them make sure you're growing at X% so you can attract an investor in the next round. You're more saying watch your runway, make sure that's as long as probably can be, and then also make sure that you're completely into this because it's going to be a relatively long slog. And when you get to the end, it's going to be a not just the competitors you've had all along, but an entire new crop of companies that are raising in more, I don't know, happy times. And so there's going to be a new set of competition that arises right when you're just coming out of a thaw.
Yeah, my biggest fear is that people are going to hunker down and have businesses that are just not interesting on the other side. It'll
Yeah.
be two people in a garage. It'll be flat forever. And I can say investors just aren't going to care. So like, what's the point of like surviving for survival's sake if you have to cut so deep that that's all you can do? I don't understand that logic. I understand getting slim enough to have a viable company on the other end, but just surviving for survival's sake strikes me as an odd choice.
I want to let Natasha talk about fintech in a second. But do you have any portfolio companies that have 36 months of runway?
I do actually.
Oh my gosh.
I have a couple that have substantially more than that, but it's also tends to be a function of they raised a large round recently and they have not yet hired and ramped up expenses to grow into that.
Got
But
it.
I don't know. I not many, but we have a few.
Something to be proud of for sure. Before we get into fintech, I wanted to talk a little bit about diversity. I know that's a part of your thesis at Precursor. Wanted to hear kind of like your at-large thoughts about how this is impacting the fundraising environment for underrepresented founders. My first thought was, already struggling to access capital when capital is getting a driver. Tell me more.
Oh my God. I'm like so terrified right now. And I don't want to be alarmist. But I do think if you just look at the numbers, even in probably the greatest bull market I've seen in my lifetime as an investor, to your point, people of color and female founders struggle to get access to capital and definitely struggle to get access to capital anywhere nearly close to their portion or representation in society. And that's a whole longer conversation about why that happens. So my fear is that two things are going to happen. One is that as investors become more conservative and cautious, they will gravitate toward backgrounds and networks that they know well. And they will go back to the well at the schools that they went to, the people that they worked with before, the people with whom they're already most comfortable. That is generally speaking not female founders and people of color. So I worry a lot that like they will be a casualty of this sort of increased fear among investors of sort of risk. I also worry that, a disproportionate amount of the capital for those folks comes from women-led and people of color-led venture funds, which also historically haven't been very large and have been difficult to raise. And I wonder what happens if those capital providers have a hard time raising their next funds. Like, who's going to write those checks? So I worry that we were just beginning to get into the groove of seeing real meaningful progress, and that we might just take a huge step back in the name of people being more conservative and cautious in terms of who they back. So that's the big thing we talk about internally at Precursor is we're not going to change our risk tolerance or risk profile for the people that we want to fund, but we will try to make sure that when we fund them, we're bringing enough capital to the table to help them get a little further down the road.
Yeah, I think one of the first times we chatted, I had emailed asking how do you go about investing in diverse founders, and you said, to be honest, like we don't do anything special, we just do it.
Yeah.
And you have a diverse team as well, so I think it speaks to that as well. So, and also I was wondering, like, do you think that there's any way that you hope other venture firms try and start supporting diverse founders? Like, what are the ways to kind of, at least in some way, fight against an even bigger threat of a lack of funding for these people?
I think it's really important for a lot of funds to just talk to the founders of color that they have in their network. And I think in the same way that a lot of my VC peers, as they started funding more female founders and talking to them and hearing their experiences, things that they maybe wouldn't have been attuned to or maybe thought about or maybe frankly didn't even believe were happening. It's very different when it happens to somebody that who's in your network than when it happens to sort of an abstract person. So I would encourage the VCs who are interested in the experiences of founders of color to ask to ask what it feels like. And I'd also just say, be conscious of the fact that sort of by becoming more conservative, don't let that change who you think could be successful as an entrepreneur. Like don't, and we say that we do this intentionally internally a lot, just say, hey, let's make sure we're not over indexing on caution and changing who we think can be successful in this environment.
Yeah, totally. So Alex, you want to take it to fintech? Now your favorite topic?
Yeah, well, I mean, it's not SaaS is my favorite topic.
Oh,
if we're gonna
true.
be totally honest, but fintech is something that's been Natasha and I have been working on as a team quite a lot lately, and we've just spoken to a number of fintech investors or investors who work with fintech companies, and we did something kind of interesting. We asked them to kind of stack rank different parts of the fintech world and kind of what they thought was going to be the most successful and the least, and we were surprised to see some similarities in responses. We thought it was going to be a bit more varied, but people were concerned about, consumer lending, business lending, consumer payments, that sort of thing. So I'm curious if you guys, we know you're in Phoenix, for example, so you're in the fintech space. When you're thinking about the fintech world, which has been super active in the last 18 months, right up until COVID, what are you excited about? What are you looking to put money into? And what has become less attractive to you aside from just restaurant payments, which we all know that that's
going to be
today.
That's going to be tough until restaurants open back up. I guess what I would say is the whole lending, and we're in Clearbank. We have, we've done some stuff in the lending space. I think what's going to be interesting is I think everybody looks like a great underwriter in a world where everything is going up and to the right, and like there aren't a lot of losses. Like you feel like your underwriting model's pretty rock solid. And like my hypothesis is the more access you look, some of this is customer selection. I think if you were lending to a bunch of retail storefront businesses, you could have done all the world's great underwriting. You're still going to be in a world of hurt in the pandemic. I think the thing that's interesting to me, at least in digital, is that you have access to so much more real-time information about how your customers' businesses are performing. Like you're able to see on a daily basis in some cases, what are they doing on Stripe? Or what do the payment volumes look like on Shopify? You can get access to richer information. So I hope that means that digitally powered B2B and B2C lenders do a better job and are able to withstand losses better than others. But I think also we just sort of don't know. We haven't had sort of a mass economic event like this in a long time. And what happens to sort of neobanks and people who are lending money to the consumer and all of these new things that were great. Like I've heard anecdotally from some of my friends who are doing life insurance startups, the demand is way up.
Ooh.
Which is kind of morbid, but it kind of sort of makes sense. And so I think it's very difficult to know, but I have to believe that there will be a few people whose underwriting models, it turns out, were not as great as we thought they were. Or maybe they just had the misfortune of being concentrated in a customer segment that was really, really hammered.
Yeah, it does make me think about like the kinds of companies that were born and were successfully funded on the basis of a up market. And I wonder let's talk about Phoenix a little bit, payment infrastructure. How do you see that side, I guess, playing out in the next 12 to 36 months?
I guess I just feel like there's still so much opportunity in payments, mostly because it's very difficult from a regulatory environment for the big banks to do R&D and roll out products. So I expect that most of the innovation that we see in financial services is going to continue to come from startups, just because I think startups they're uniquely positioned in fintech to do things quickly in a way that I think big established companies cannot. I don't think we've overfunded the opportunity in fintech by any stretch. I think to me, the most interesting question is, I have a ton of admiration for Stripe as a company. They're playing in a lot of different arenas now, not just sort of, they've got card issuing, they've got all these other products. And I think the question is like, when will they have their Google moment where we figure out this is the domain of things that Stripe can do well and dominate, and these are the areas that are outside of that where they're competitive, but maybe not. I think we don't know that yet in sort of like when I think about fintech. I mean, Adyen's managed to do quite well in the presence of a Stripe.
Mm-hmm.
But I do think that it's interesting to me. There's just a lot of companies that all seem to want to get into everybody else's. Brex has big ambitions.
Yeah. So we've seen this in fintech. I mean, not to niche too far down on fintech, but like it seems that every fintech company had a bit of a wedge. Acorns was going to help you save pennies. Chime is going to be a neobank, and then they all go super broad as fast as they can, because once they get people into their platform. They've already paid the CAC. Why not try to increase the LTV by adding features? CAC, customer acquisition cost, LTV, long-term value. If you're not super read up on venture acronyms, hopefully you're not. But I'm curious, one, is that a trend you think is going to continue? And two, does that make it harder for companies that are pre-seed to find a space or a niche inside of fintech, which is a big startup sector, to really kind of like make a home and drive growth?
It's super hard because for two reasons. One, all of these, to your point, all of these companies aspire to do everything, which means one of two things, which means investors are skeptical that you'll be able to win as a niche player. And two, many of the people you'd like to go get money from are conflicted out because they're in some competitive investment and there's nothing else you can do. And so I don't know. I will say this. I think right now consumer fintech is probably one of the most difficult categories to start a new company in today. When you think about cost of customer, I'm speaking purely from the pre-seed side.
Sure.
When you think about the cost of customer acquisition, when you think about the sort of fragile nature in a world of whatever, 26, Alex, you're better at the numbers, 26 million people have filed to date for unemployment. Is that
just over 26 now? Yeah.
Like it's hard. People obviously care about money in times like that, but how do you solve the business model piece? How do you solve the customer acquisition piece? And remember, pre-seed companies, they're raising $500K to $1 million. That is not a lot of money to work with in a world where, bigger players can afford to bid much more for the customer. So it's a very tough segment to play in right now.
Yeah, I wouldn't really fancy it. Tosh, before we go into, we've got a great list of Q&A from the audience. I want to make sure we save a bunch of time for that. Any more on fintech from you, Tosh, before we go?
No, let's jump into these questions. We're getting a lot.
Yeah, so people have been asking about the social space in particular. And so we have to start with the obvious question that's been all over VC Twitter. Well, start here. Clubhouse, have you used it?
Yes, I enjoy it.
You're cooler than we are, or that I am at least.
I have yet to actually log in and use it. But the question about Clubhouse has been making some noise. Are there any concepts piquing your interest in the social space, the consumer social space?
About half of our fund is consumer, and I love consumer social. It's been very difficult to invest in these categories historically. By historically, I mean the last 24 months. Because I think people have been really concerned about, Facebook, Twitter, like those companies have so much audience and power. How can you possibly create an opportunity? So one of our most recent investments, I won't out it because I don't have her permission, is in it's basically a community powered social networking company. And I'm like really excited about what she's building. We've been investors in Marco Polo from the very beginning. They're seeing a big uptick in usage with people sort of sheltering in place and wanting to talk to their loved ones. So maybe I'm just naive, or maybe I'm just too much of an optimist. I just think consumer habits and preferences in consumer, the half-life is like 2 years. People are always open to something new if it's fun and entertaining. And I don't know if I've read a bunch of like hot takes on Clubhouse. I'm like, I think it's a fun product. I have no idea whether it will be something that many, many people outside of VC and tech land will find interesting, or it'll be one of these products that only sort of speaks to us. But I think Paul and Rohan and the team have done a fantastic job with the product. I am not an investor.
Good point. Thank you.
I just want to be clear. I'm not an investor. I'm just a fan of Paul's work and I like the product. And I think it's like, I tell my friends, it's the perfect quarantine product.
I wanted to push on that a little bit too, because I saw someone made this point recently about, are some products just benefiting from quarantine? Yes. So up across the board. When you're as an investor, how do you look at a social consumer company and know that this has legs, and you didn't expect a pandemic to happen? So how did you do it before that?
I guess I always ask people the same question, sort of like, what is your insight about consumer behavior or like some unmet consumer need? And like, I think you have to start with that. And if you have a good answer for that, I think you've got a fighting shot at being successful. I think the other thing that's like, to me at least, fascinating in consumer right now is there used to be this world of, you had like offline, you had like The Wing, WeWork, you had like these offline businesses, and then you had like digital businesses, and they felt separate and distinct. And now all of these offline businesses are finding out that they have to become digital business, and it's really muddying the playing field. And it's becoming, for me as an investor, hard to figure out like, well, who's going to win? Is it going to be the offline people who who already have audience and are trying to figure out digital, or is it the digital people who understand digital but don't yet have audience? And like, how does that all sort out? And it used to feel much more neat and clean previously.
I'm curious about how niche a social network or a social product can be and still be big enough in the end to be interesting from a venture perspective. Natasha and I were talking about a company earlier today that was a new publication that was focused on celebrity gossip. It was launching with a subscription model,
Oh
kind of
yeah.
a niche topic. Super cool. Yeah. But the same idea probably applies to social networks in that Facebook is going to be probably the biggest broadest social network, but that doesn't mean there isn't room for more targeted, more niche, and more kind of probably intimate social networks. And so I'm curious if you've seen people building stuff aimed at slices of the population, slices of the world, and then how you tell what's a big enough TAM, what's a big enough market to actually kind of grow into.
I've seen tons and tons of this, and I'm really glad to see the energy come back to this category. I guess the thing I will say is venture is not a monolith. The TAM that's interesting to Precursor is very different than the TAM that's interesting to a multi-billion-dollar multi-stage venture fund. Look, I think what we know is that if you can become a general purpose social network that connects everybody on the globe, it's hundreds of billions of dollars. And if you can become a sort of more narrow social network that really captures the imagination of a smaller demographic like Snapchat or Twitter, it's tens of billions of dollars in value. And then it's a gigantic drop off and there's not much in between. Yeah. And so I think the question is like, how unmet is the need that you're going after? And I think if you're going after a popular, like I've seen a bunch of really interesting companies being built by LGBTQ founders, specifically trying to meet the needs of their audience in ways that existing platforms do not. And I think that that feels like big enough that if you get it right and that you win and you become the platform, to me, that feels big enough. But I don't know if we're going to see another Facebook scale or Instagram scale network soon. And now that I've said that, it means someone's probably starting it right now. But I just think like that's a high bar to get to billions of people around the globe using your product. I mean, Zoom's at what, 300 million DAU now?
Exceptions and rules.
Yeah. That's right.
I want to talk about one of your investments that I was super excited. I found it separately, saw it Precursor was an investor, the Juggernaut.
Oh, yeah.
It's an outlet focused on South Asian population. And, it has both that niche organization and it's a media outlet. So I would love to know kind of what your interest was in investing and how it's been doing. And if you're going to do more of investing in those kind of companies.
I sure hope I can find more of them to invest in. So I've always liked media as an investment category. I guess my view has always been, yeah, right.
Like, we appreciate that.
Right. And I guess I feel like media is a big part of what people actually consume on their phones and during the day. And like, it's not just email and spreadsheets, it's entertainment. And, we were early investors in The Athletic, and that sort of gave me a view for how powerful the economics can be if you can get a good degree of retention to work for these models. And I think for a long time people said, well, consumers won't pay for content. I just don't believe that's true. I think they won't pay for poorly written content. I think they won't pay for content that they can get anywhere else, but they will pay for, like, I've been a subscriber to The Information for a long time. I really enjoy reading the work that they do. So I think the Juggernaut, though, when I met Snigdha, I was like, wow, the TAM for you, it's like 1 billion plus people minimum, maybe 2 billion around the globe, who, and particularly the United States and North America, who are not well served with content that's written about topics and people that they care about. I think you could build a really big business there. And I think my challenge is always, my default assumption is if somebody can build an ad-supported free version of your product, they will in media. And I would say that, like in sports, The Athletic were able to get such high quality writers that it would have been difficult to rival that with the free publication. And my bet for the Juggernaut is that she's going to attract such strong writing talent that it's going to be sort of the only outlet that can generate the quality and kind of stories that would encourage someone to continue to subscribe. So I've looked at a couple of other things in state level politics, like focused on the state house. I continue to have this like white whale obsession with finding something that works in hyperlocal news. So I will probably continue to look for that forever.
You're not the only one.
I know.
Yeah, please keep us updated.
And there's probably a few other categories, but like I didn't have a thesis on the Juggernaut. I met Snigdha and I was like, I think this will work based on what I know from previous investments. And so I suspect whatever the next one is that I do like that, it'll be something where the founder has all the insights, not me.
Yeah, totally. Pivoting a little bit to D2C, earlier this week we saw Casper have layoffs pull out of Europe. Wondering if that's trickling down to the pre-seed, to your thesis right now on the market.
It's interesting. We have our first precursor. We have for the first time a company that's both raised venture capital and raised money from sort of one of these alternative to venture capital type arrangements. And I think the sort of the silver lining for pre-seed D2C companies is that market got bad in the middle of last year. And so I think they've had almost a whole year to adjust to a world in which venture capitalists are likely going to be far less enthusiastic about investing in those products. And so most of the good ones that I know have made the adjustments and said, hey, let's assume that we're not going to be able to raise tons of venture capital to power customer acquisition. And the nice thing is we're a teeny tiny fund. I mean, we're small in the grand scheme of venture capital. So I don't want future dilution any more than the founders do. So I think what you're going to see is you're going to see some of these D2C brands that have raised relatively small amounts of money have what for them will be good, tens of millions or even $100 million outcomes where the founders are going to own 70, 80, 90% of the company. And these are going to be multi-generational life-changing events for those founders. It's probably going to take longer, but they have already adjusted to a world in which venture capital is going to be far more scarce.
That's refreshing. Yeah. I mean, Clearbank, also one of your portfolio companies. I feel like they launched the Runway product recently. Wondering, and do you know if did they broaden it out to D2C as well?
They're always experimenting with new sectors, so I won't
Hard
say
to keep
much.
up.
I don't know how much I can say, so we'll just say that they'll be announcing some really interesting things really soon.
Okay, we only have about 10 minutes left, so we're going to go through a couple of these questions pretty quick because I don't want to leave people hanging who've been waiting. So I'm going to do SaaS, Tasha's going to do mental health, profitability and growth, and then we'll wrap. That's the plan. So I love SaaS, so I had to get to this question. I'll just read it out loud. Meanwhile, the bar is super high for SaaS founders where tons of early traction is demanded. Is this going to change post-corona, seeing the stumbles of consumer-facing companies?
This is a really hard question to answer. I have this long-running SaaS thesis, which is it's very easy to get started in SaaS. We now know that you can get to $1 million in ARR in SaaS, and it doesn't necessarily mean what it used to. And I think we know you can get to 10 or 20, and then there's this gigantic gap. Like, what happens next? So my hypothesis is that there were probably more niche-y vertical products in SaaS that got funded sort of for SaaS's sake. They were SaaS companies. The product orientation made sense. And I think there's going to be renewed scrutiny on is this ever going to become a big company? And so I think what you will see is a culling of things that feel more like features or elements that should probably be part of a bigger system. I think investors might decide they don't want to continue to fund those companies, and that those companies might find themselves in a universe where they have to explore M&A. I do think we're going to see a rethinking of how many, individual thin slice niche SaaS companies do we need? The flip side is I think it's a great time to be focused on trying to solve big problems for industries where software doesn't have much of a footprint or presence.
Yeah. I saw a company like that from Atlanta called Single Ops just the other week.
I'm gonna quickly, Grace, on mental health. You mentioned your own founders dealing with this. No, they're definitely not the only ones. Was wondering how you're viewing mental health startups and just mental health within your portfolio as well.
I think mental health is a huge problem. I mean, we have one investment in a company called Modern Health, which was since rebranded to Modern Life. I think it's a great time to be providing telehealth, mental health services for people. The demand has never been greater. I have to say, I'm particularly worried in general about any founder out there who might be a solo founder. This is my canonical person I worry most about. Solo founder living in New York in a 300 square foot apartment with no roommates, who can't safely go outside and doesn't have a co-founder. So we've sort of internally upped the volume of community stuff that we do. We already have a pretty active Slack channel. We've been trying to do more events for the portfolio as a group, and I've been trying to encourage people to check on their other founder friends, because sometimes it's weird when your VC checks on you because of the power dynamic. The person may or may not be comfortable being as honest with how they're doing. And I think it's absolutely taking a toll on people. And I don't think we'll know I think right now a lot of people are like, I'm going to find a way to get through it. I don't think we'll really have a good sense for the toll until we're on the other side and people can breathe a little bit more. But I think there's going to be some trauma. Like, this is not just working from home.
Right.
This
I
is
think that's
working from
important to
home.
remember for
This
sure.
is working from home during like you can't just go outside and stretch your legs and get a break or go grab a coffee with a friend. Like, this is like working with trauma. And so I worry a lot that we don't know how this is going to impact people. We also don't know how people are going to respond when some of these restrictions are lifted. So I've been spending a lot of time on it. I don't have a great answer. We're obviously talking to more and more mental health startups are showing up in my inbox every day. So I'm glad it's continuing to get the attention it deserves.
Definitely. And just one off from that. I know we're ending on time soon, but do you think in the near future there'll be mental health services for your portfolio companies? Is that something that's already in place?
I really admire the things that Freestyle and other and I'll tell you, I have maybe like a slightly controversial take on this, but my view is, I don't know if when I was a founder, I don't know if I would have wanted my venture capitalists at all involved in my personally. Like, I don't know that I would have wanted them involved. I think I would have wanted permission and support from them to spend my company's money on my own mental health. And I've told many of our founders, your company is so dependent on the decisions that you make. Spending money on your mental health is absolutely something I'm supportive of for your company, and separate from coaching. Like, I think coaching is different from mental health. So I struggle with, like, because the power dynamic as an investor is that, like, you are judging the companies that you invest in. It's part of the job. I don't know if commingling mental health support with sort of your role as trying to be a arbiter of success. I don't know. That to me feels like a slightly uncomfortable combination.
It's tricky.
So I have not yet found a way to reconcile our desire to support founders in this with something I think also preserves their privacy, autonomy, treats them like adults. And also, what if they don't like what if they don't like the provider that I've partnered with? What if they need something that's different? Do we have to, I haven't been able to find something that feels appropriate for our portfolio and our values, but also like recognizes the really big need around this topic.
Yeah, it sounds a bit like having your spouse pick your therapist. It's a
little bit
like no one wants that. Like, in the history of the world, zero. One last question, and then we're gonna wrap. There was a question from the audience about profitability and growth, and I'm going to narrow it so you can answer it a bit more succinctly. They're asking about companies switching a little bit more towards profitability, a little bit away from growth. I'm curious about how you're seeing companies deal with this now that have raised money. So not companies that are desperate and might need to raise in 2020, but companies that have 8 to 24 months of runway, enough cash that they're not concerned now. Would you recommend that they begin to decelerate spend, presuming reasonable unit economics and so forth, just to give themselves more space? Or would you recommend going a little faster, having the better growth profile, so on the other side they are still attractive, as you mentioned earlier?
It's a great question. I can tell you how I handle this with our portfolio company founders. I think in a world where everything is about growth, if you were that lone founder that wanted to run a profitable business, there was no oxygen in the room for you to probably have that conversation. And now I think that we're in a different environment. I've gone back to founders and said, hey, you don't have to stay on the venture capital treadmill. You're close to profitability. You could make the decision today that we're going to run this business profitably and we're going to focus on sustainable growth. I will support you in that journey, but like, you have to be very conscious that that's what you're doing, because I'll advise you and think about your business differently than a company that's like, well, we want to temporarily get profitable so that we can ride this out, but we want to get back on the growth lever. And I've found secretly, I've met a lot of founders, not just in my portfolio, but broadly, who I think know the businesses that they have maybe won't become $200 million in revenue businesses. And probably for them, growing a little bit more slowly and maintaining ownership and control is probably more suited to their DNA and more in line with how they want to run the business. And again, because we run a small fund, this is not a conflict for me. As long as they build a great company, we'll be fine. We don't need to put $20, $50 million to work and have a multi-billion-dollar outcome for our model to work. So I think it's given founders space to be honest about the kinds of businesses that they want to build. And I think increasingly, whether it's indie VC or others, they're finding other people who I think want to partner with them on this part of the journey. And so I don't know how to tell a founder who wants to be profitable that they shouldn't do that. They should instead shoot for the moon. I think I'd be pretty unsuccessful in convincing them to do that.
Sadly, we have to stop.
Thank you so much, Charles, for
this was great.
Yeah, this was fun. Tell us the best, or don't tell us, tell everyone listening, what's the best way to pitch you and get on your radar right now?
Oh, probably to just email me at charles@precursorvc.com. Or if you have more materials, you can also we have a little startup submission form on our website. We actually all look at them as they come in. So that works too.
All right. And thank you everyone for turning up. This is the second time we've done this. There's been a ton of work on the back end. So we wanted to give a shout out to the tech team that helped put this together, the YouTube stream together, all the graphics that we're going to have. There was an enormous amount of work that went through Anna for helping out with the questions. It's a team effort. So thanks to them. And coming up, we have Mission Frida Kapoor. We have Mark Cuban next week. And then we have Roelof Botha from Sequoia the week after. So a lot of stuff coming down the pike. And Tosh and I are on some of those. So if you want to see more of us, you will get to. But in the meantime, thank you all, everybody, for your time. And Charles, one more time, thank you for dropping by, for giving us a whole hour. We really appreciate it.
Thank you for having me. It was a pleasure. All right.